This tutorial is a project of nonprofitaccountingbasics.org, a free resource developed by the Greater Washington Society of CPAs Educational Foundation. Our goal is to encourage accuracy and accountability to help smaller nonprofits successfully manage and sustain their organizations.
Hi, I'm Bess Hamilton Foley, and today we're going to talk about restricted contributions basics. Before 1995, when the Financial Accounting Standards Board, that's known as FASB, decided that unconditional promises to give should not create a liability, many nonprofits were doing just that, recording such contributions as deferred revenue, a liability. Since 1995, organizations are required to record all contributed income when it is received or unconditionally promised, like a pledge, whether restricted or unrestricted. So, what exactly is a restricted contribution? The simple answer is it's a gift on which the donor has placed a restriction. But of course, it's a little more complicated. Restrictions can be permanent or temporary, and temporary restrictions can be for purpose or for time. Permanent restrictions happen when a donor restricts the contribution to an endowment that should never be spent. The income from the endowment may be unrestricted, or the income can also be restricted by the donor for a specific purpose. For example, a memorial fund for an orchestra member may specify that income from the endowment will only be used to pay the salary of the first violinist. The funds in the endowments are not liquid, so most small and mid-sized nonprofits should not seek to create endowments, as it is better to first build accessible operating reserves. Gifts of real estate or other property, such as art or museum collections, can also be permanently restricted. Since most small and mid-sized nonprofits will not have endowments, we will now focus on temporary restrictions. Temporary restrictions happen when a donor places a temporary restriction on the use of funds or the asset that they give you. A donor may impose a time restriction for a future fiscal year, or a donor may impose a purpose restriction, for example, for a specific project, program, activity, or to support a specific staff position or technology purchase. You get the idea. How you ask for funding can imply a restriction. Funds raised during the new van campaign can only be spent to purchase the new van, as donors gave the money for that purpose. When the cash arrives can also imply a restriction. An award letter arriving this fiscal year may be restricted to next year if the cash does not arrive this year. The time restriction is implied by the donor's choice not to send the cash until the subsequent period. There is more to know about restricted contributions. For instance, only donors can impose restrictions. Board designated does not equal restricted, although board members can give you restricted contributions, so it's a matter of keeping it all straight. Only contributed cash or assets can be restricted. The expenses related to the purpose for the restriction are never restricted. The funds are restricted, not the supported activity. Accepting a restricted contribution is entering into an agreement with the donor to honor the terms of the gift. Restricted funds may not be used for non-restricted purposes, for instance, to alleviate cash flow crises. Instead, build an operating reserve fund or activate a line of credit. So, now that we've received our restricted contributions, how do we track them and carefully monitor how they're being spent? Restricted contributions often affect more than one fiscal year. They affect both the balance sheet in the net assets section and the P&L. Since the P&L, that's your profit and loss, only shows the activity for 1 year at a time, it's easier to navigate the impact of increases and releases of restricted contributions from year to year if you create a list, or what we call a schedule, covering multiple years. In this example, Agency A gave $10,000 in fiscal year 1, and that's the year's ending balance for temporarily restricted. In fiscal year 2, the $10,000 was released to pay for the youth program, and the ending balance for fiscal year 2 for that grant is 0. Also in fiscal year 2, Agency C promised $7,500 for the next school year, and Foundation D gave a contribution for the following fiscal year. $4,250 of the Agency C funds were released to pay for the part of the school year that was in fiscal year 2. The remaining $3,250 carries over to fiscal year 3 to cover the second part of the 2-3 school year. All $8,000 of Foundation D's funds carry over into fiscal year 3 as restricted by the foundation. In this example, releases were less than new contributions, so the net from the restricted activity was positive. If more was released than came in new contributions, the net from restricted activity would be negative. This is usually a timing issue and no cause for alarm as long as the net from operations is positive. In conclusion, accurately tracking restricted contributions can be confusing and complicated, but doing it well will help you to honor your donor's intentions. Thank you.